A massive warning has just been given for the crypto and stock market.
Welcome to the Bean Pod. This is your place for all things stocks and crypto. From beginner tips to expert picks. Use this as fuel for your investing journey, because when you're in the know, your money will grow.
The Bean Pod is presented by DAOmaker, the top crypto launchpad in the industry.
DAOmaker allows people to participate in top crypto projects before they launch and generate some of the best returns you can find anywhere.
They also provide growth solutions for crypto projects that are looking for funding and assistance with marketing.
With their revolutionary new public strongholder offerings, everyone can get early access to top crypto projects regardless of their net worth.
DAOmaker is rapidly disrupting the venture capital industry. If you're interested, head over to DAOmaker.com to learn more. This episode of the Bean Pod is sponsored by KyberSwap.
KyberSwap is a DEX and DEX aggregator which is built to facilitate all your DeFi needs in one single platform.
Fast, cheap, and safe.
User experience is KyberSwap's sole focus to make everyone's life better in DeFi. Welcome to the Bean Pod. This is Shane, aka the Jolly Green Investor. Today, there is no Josh, the Nifty Investor. He wasn't able to make it for today, but I've got some pretty interesting topics about a massive warning that was just given for the crypto and stock market, so we need to discuss. So, things are pretty volatile right now in the stock and crypto market. It seems like the prices are going up and down every day. You hear talks of recession, inflation, mass layoffs in the tech industry. There's a lot of different factors that are making people very careful and weary about the stock and crypto market in general. But what I'm looking forward to, I shouldn't say looking forward to it, what I'm looking ahead to is the potential for another leg down. And that means stocks, Bitcoin, crypto, and everything that, people who watch this show might want to invest in could be taking another massive hit. So there's some warnings that I've been reading in the news that maybe have gone a little bit unreported that I want to talk about today. So if you're invested in stocks or crypto, this is an episode you need to watch to the end. And if you like this content, by the way, make sure to like and subscribe. Helps the channel out a lot. All right, so this is what I'm talking about. There's been multiple warnings from high-profile companies and executives that profits and revenue, so earnings guidance, this is the stock market I'm talking about, are going to be decreased significantly coming in the next earnings season. So stock market companies, public companies, report their earnings quarterly. And the quarterly earnings, the next round of them, is going to be happening in mid to late July. This is an opportunity for us all to see where the market is headed. So based on what the insiders are saying, what usually happens in a run-up to a recession is that the market will price in the stocks coming down months before the analysts start writing down the price targets. So to put it in simple terms, a company like Apple, their stock has been falling, but the analysts have not yet downgraded their stock price target for next year yet, but it's coming. So this is what people are warning against. When the earnings start coming out for their Q2 earnings, which is in July, mid to late July coming up, the price targets for all these companies, tech companies, all these growth companies are going to be slashed, or could be, I should say. Nothing is for certain. Could be slashed significantly. And this will trigger shockwaves through the crypto and stock market, which will bring all the asset prices down again. So because we've learned from history and we see that there's a delay, we can see that while stocks have been tumbling over the past 6 months, the guidance for the earnings doesn't quite match up. So I pulled up a few stats here. At the end of last year, analysts expected S&P 500 components to deliver an average of earnings per share of $5.87 for the fiscal year of 2022. By the end of May, so just last month, that number has grown to $6.15 per share. So despite all of these warnings in the economy, recession, inflation, supply shortage, employment problems everywhere, not to mention the current ongoing crisis in Ukraine, the estimates for these companies is actually higher than it was before. So to me, that makes no sense. And I think it's an opportunity to sit in cash and wait for another dip. Or if you want to play the shorting game, maybe that's your thing too. But based on what we've seen the estimates are rising, which is in part due to rising inflation. But we're looking at inflation, labor shortages, lockdowns in China, rising interest rates. The Fed is taking money out of the market. But the earnings reports and guidance haven't caught up yet. And this is the key. So this is the domino effect that I've been thinking about that we could see play out come mid-July when the earnings reports start. The banks and the financials typically report first. So what we might see is the guidance from the banks, who, the backbone of the financial economy, they start to get lowered. And then people will start to get scared. And then when the earnings reports for tech companies come out, and this is what happens with growth tech and tech in general during a recession. Most of these social media companies and big tech companies, all these guys, one of their biggest revenue drivers is ad spend. And when companies aren't selling as many products and they need to cut costs, well, they have to cut ad spends. So you might look at companies like Amazon, Facebook, Twitter, Snapchat, Pinterest, Google, these huge companies that rely on advertising revenue. They're going to be slashing their guidance significantly because companies are A, going bankrupt and they can't spend on ads anymore, or B, they're just not going to spend as much. And then we look at to the consumer side of thing, where people are struggling to put dinner on the table. With rising food costs and people getting laid off from work, they no longer can spend as much on these tech products. So we're going to see the tech guidance for their revenue going forward decrease significantly. And that's where crypto comes into play. Because as we know, Bitcoin currently is 95% correlated to the NASDAQ, which is tech stocks. So as soon as tech stocks have their earnings slashed and their guidance decrease significantly, and what that means is what the companies expect their revenue to be looking like moving forward for the next 6 to 12 months. So if they say, shit, we really are heading into a recession and people are really going to be spending less, both from the consumer side and the ad spend side, and that we're dealing with supply shortages, all this stuff, this looming economic hurricane, which I feel like is on our doorstep, but a lot of people are ignoring it, or the analysts are late to recognize it for whatever reason. So when we see these tech stocks bring their valuations down, the NASDAQ could go for another plunge. That means Bitcoin could go for another massive plunge. And in turn, because all altcoins follow Bitcoin, they could all go for a massive plunge too. So this doesn't just apply to these old school stock market investors. If you're might be a bit of a younger investor and you're specifically into crypto, it's reasons like this why you need to be watching the stock market, because the stock market at the end of the day is dictating the direction of crypto. So here's what I'm doing. Currently, I'm sitting a lot in stable coins. I know we're in a range for Bitcoin and crypto specifically. So, maybe buy the low of the range, sell the top of the range, or short the top of the range, but very small positions because things are very volatile. But in the build up to this next earnings season that's coming in mid to late July, I'm going to be playing this very conservatively, because based on history, based on the trends, based on the stats that I've shared today and what I've been reading, there is a looming economic hurricane, and the next leg down could start as close to us now as mid-July when these earnings reports come in. All the Wall Street analysts are kind of slow to pick up on these trends, and I think I might have uncovered the reason why. So here's another stat. Out of all the S&P 1500 companies, 386 of the companies are covered by fewer than 5 analysts. So there's not a lot of people covering the companies, and these are the analysts that are doing these upgrades or downgrades of prices. About 430 companies have between 5 to 9 analysts covering them, and only 162 companies in the S&P have more than 20 analysts. So there's a bit of a shortage there of analysts covering the companies, which could be a reason for this lagging effect. And the lagging effect, again, is that it takes about 5 to 6 months from when the company's prices start to come down to when the analysts start really downgrading prices, which creates a cascading effect. And right now, we're about 6 months into the stock market sell-off. So based on historical trends, this is the time where the guidance is going to get lowered. And so be it, we have this next earnings report coming up in about a month and a half. So what can you do if you don't want to just sit in cash and you don't want to just short crypto and all that kind of stuff, even though, judging by all this stuff I've just talked about, we could be sitting in for a very tough period? There are certain sectors of the stock market specifically. Crypto might have a bit of a tough time. So I would be very, very careful about that. But stock market, there are certain sectors of the stock market that hold up well during recessions and that hold up well in the build up to the recessions, which is this period that I think we're rolling into right now. And these are the stocks, if you have been following the Bean Pod for a while, these are the stocks that Josh and I have been talking about for the past few months. It's the food stocks, it's commodities, it's energy, it's materials, industrials. You know, we've shifted away from tech stocks, if you've noticed, over the past 4 months. And if you watched our stock market rotation episode, you would know that this rotation is a multi-year trend. So even though it started, we may not have missed the boat. So what I'm doing is positioning my stock market portfolio heavily in these energy stocks, food stocks, staples. And if you want the names for the food stocks and the energies and the staples and all that kind of stuff, go watch those episodes. We do have episodes based around each of those sectors in particular. We did a food stocks episode. We did a recession stocks episode. So go check those out. I'll link them at the end of the episode. But there are ways to position yourself just more defensively moving forward. So look, we could be heading into a tricky time economically. And from all this research that I've done and all the bad factors that are moving into this economy, I think this next earnings season that comes in mid-July could be a big time bearish catalyst for the stock, Bitcoin, and crypto markets. So just play it safe and look, have a look at those other episodes we did. Maybe you could learn something, and just make sure that you listen to the next episode because it's going to be a banger.
All views expressed by speakers on the Bean Pod are solely their opinions. You should not treat any opinion expressed on the Bean Pod as a specific inducement to make a particular investment or follow a specific strategy, but only as an expression of their opinion. This podcast is for informational purposes only.